approach and what's meaningful to you. At the macro level, that's fair. So there's three things you could have. You could either say we're all going to have the same, and let technology highlight to the investor where there's a change, and they judge if they think that change changes their analysis or not. Or you have the pure management red flag approach where you only talk about changes. But what we have today is an in-between approach. We have a red flag approach except for the following 15 items. So the board needs to figure out, do we want to do all the same or a pure red flag approach, or if we're in the middle, where do we want to identify the requirements? So one of the things I think we ought to focus on is the requirements when we talk about a material change. Is it transactional only or transactional and measurement? So Dave Sullivan made a great point. I just want to emphasize it. Dave Sullivan talked about, and he used derivatives, and he probably used derivatives for a few reasons. One, a lot of disclosures, but two, derivatives are remeasured. So you could have a situation where there are no new derivatives, and the company has not gotten out of any derivatives, but you may have a material change on the reported financial statements, and is that something? So I've created a distinction between transactions and measurement, and that would be important, I think, for the board to know. When we're talking about the red flag approach, is it only new or change in transactions, or is it also a change in measurement of existing transactions? Fair, Dave? Yeah.
So my reaction reading through this is whether any of this is intended to change how this applies to nonprofit organizations with public debt. And when you look at most not-for-profits with public debt who do disclose summarized financial information according to their covenants, most don't do any of this, and they don't feel that the existing language is applicable. A few of the larger health systems have, and you will see financial statements that look and incorporate these items. But I don't know if this change is intended to create clarity on that, because if it's going to bring in nonprofits with publicly traded debt, this would be a significant change for that part of the industry that most are not prepared to do today. And so that's just the point I wanted to bring up.
John.
I guess first just a technical drafting question. In the first place, the first paragraph where you got all the underlined, I'm trying to understand what the time frame is, because it says if there has been a significant event or transaction that has a material effect. Do we mean during the period? Do we mean something that hasn't been previously disclosed? I mean, say the event occurs in January and it's reflected in the annual financials. I feel like you need a time frame in there. And I guess related to that, when I go to the AA paragraph, if you end up with disclosures in the first quarter, as read, you have to repeat them in the second and third quarter. Is that,
I've always understood that. So to answer your second question first, I've always understood that the quarterly notes are an update of the previous annual. So I'm not thinking that by the time I get to the third quarter, I have 4 reports in front of me and I'm looking for the relevant piece of information across all 4. I always thought it was between the previous year end and the third quarter. At least that's the way I used to prepare financial statements, that I was only levering off of the 2. So yes, there was a build effect, if you would. That's how.
If we're trying to reduce repetition, having to repeat it 3 times doesn't reduce repetition. But I do think you need some sort of time frame up in the first one. Going to what Russ's comments, and I think Russ was right on. Just by analogy, lawyers worry a lot about risk factors, and the structure that the SEC now has set up for risk factors are you put extensive risk factors in your 10K, and then you are required to update them in your 10Q only if you have a material change. Or you can repeat them entirely. But every time when you have changes, if you have small changes, you just wrestle over and over, is that material, isn't it material? Because if you decide that it's material, or if you repeat it, it's kind of sitting there by itself in the 10Q. And so for companies that repeat all of their risk factors every quarter, it is much easier to make, I will say in some ways, better disclosure, because you can make smaller changes and bring them up to date without kind of making an admission that they're material, which often you don't like to do. While if you follow the structure of having all of them in the 10K and only put it in the 10Q if you've reached the decision that it's material, often you don't get as many updates. And of course, that suggests a whole lot more words, but it just makes that is what has developed in the risk factor world, and it's somewhat analogous here.
Rudy.
Yeah. Take a risk with this comment. When and this is maybe a difference without a distinction, many would say. But I think about this from the preparer's perspective, the discussions you have internally, the discussions you have with external auditors about trying to figure out what's significant versus what's material. And you're using both words here. And material ends up being a discussion of what's over 5% of something. And significant is more of a, sorry, I don't mean to be so black and white, but just to throw it out there. And significant is more of a discussion about, relevance, quality of earnings, someone used the word trends, and so there's a whole different set of considerations in there. So I just put that out there if that's something to consider in this.
David?
Yeah, I agree with John. I liked how Russ summarized sort of, is it a red flag by management, a red flag by the users, or a mixed approach?
So on and so forth. They might even throw some Iran in there. Stock markets are lower, and there's flight to safety in gold right now. Gold prices are up with what Trump said about China, U.S. tariffs. So the stock, he said, this was yesterday, as a matter of fact. Today, Wall Street bounces back on renewed trade optimism. This is on Reuters. Excuse me. Wall Street rebounded today as investor optimism got a boost from U.S. President Donald Trump's remark that the talks with China on an interim trade deal were going, quote, very well, end quote. Y'all see the madness in this stuff? Yesterday where they were down because he said it's going to go into, the elections in 2020. The markets dropped, man. This dude got so much control over the markets. So this dude jumped on Twitter the next day and popped the markets up by saying that they're going very well. All three major U.S. stock indexes snapped a 3-day losing streak with the broad-based rally led by financial, healthcare, and tariff-sensitive technology stocks. Trump's comments supported a Bloomberg report that the world's two largest economies were closer to agreeing exactly how many tariffs will be rolled back in a phase one trade deal. Fears that the stalemate in negotiations could lead to a new tariffs taking effect scheduled into December 15th have dampened market participants' enthusiasm in recent days, with the major U.S. stock averages falling back from last week's record highs. Still, even as stock markets get whipsawed by daily trade developments, Doug Cote, senior portfolio manager of Voya Investment Management in New York, believes investors should not lose sight of solid underlying market fundamentals. All right, bro. I definitely won't lose sight of what you want me to not lose sight of. But let's move forward, man, because this stuff is crazy. CNBC, next year will be hard on the housing market, especially in these big cities. So, two things I want to talk about this. Let me just read it first, and I'm going to get into that. Two things, though. But, home sales will drop. The housing shortage could become the worst in U.S. history, and home values will shrink in some cities. That's the 2020 forecast from Realtor.com, which holds one of the largest databases of housing statistics available. Sales of existing homes will fall 1.8% from 2019, according to the forecast. home prices will flatten nationally, increasing just 8% annually. The prices will fall in a quarter of the 100 largest metropolitan markets, including Chicago, Dallas, Las Vegas, Miami, St. Louis, Detroit, and San Fran. Man, it is, excuse me, a seemingly contrary assessment given the current strength of the economy and of home buyer demand, but the dynamics of this housing market are unlike any other. The result of a housing crash, unlike any other. Real estate fundamentals remain entangled in a lattice, I don't know how to say that word, man, of continuing demand, tight supply, and disciplined financial underwriting. This is George, these people's names, Ratu, whatever. He's a senior economist at Realtor.com. Accordingly, he went on to say, 2020 will prove to be the most challenging year for buyers, not because of what they can afford, but rather what they can find. It's all about supply. The inventory of homes for sale has been falling steadily for several years and is at its lowest on the lowest end of the market. Okay, that makes sense. That caused prices to overheat, weakening affordability. The 2020 forecast offers no relief. In fact, just the opposite. As demand heats up in the spring, driven by the growing number of millennials entering the market, the supply of homes for sale could hit the lowest in history. The situation will only be exacerbated by the baby boom generation, which, according to forecasts, will have little incentive to sell given weaker home prices. Two things on that. Number one, if you own property, you probably want to hold on to it. Number two, if you don't own property and you can find some next year, prices are going to go down. We buy it during the dips. If we want it, we just wait for the price to go down and do that dance. So that's my 2 cents. Moving forward. Let's jump on this. Reuters. I'm going to jump to CBS News. Reuters.com, U.S. services sector, private payrolls, growth slow. Not a good dance. U.S. services sector activity slowed in November as lingering concerns about trade tensions and worker shortages pushed production to its lowest level in a decade, which could heighten fears about the economy's health. Other data today showed private employers hired the fewest workers in 6 months in November. The reports came on the heels of the data on Monday showing manufacturing activity contracted for the fourth straight month in November and a decline in construction spending in October. The continued manufacturing slump and second straight monthly drop in construction outlays tempered growth expectations for the fourth quarter, which had been boosted by a rush of upbeat reports on the trade deficit, housing, and business investment. Still, the economy appears to be growing at a moderate pace rather than stalling. Sure, don't worry about it. Private payrolls, growth is slow, but hey, it's still growing. It's moderate. Meanwhile, almost half of Americans work in low-wage jobs. This is from CBS News. Y'all can check this out. America's unemployment rate is at a half-century low, but it is also a job quality problem that affects nearly half the population, with the study finding 44% of U.S. workers are employed in low-wage jobs that pay median annual wages of $18,000 a year. Contrary to popular opinion, these workers aren't teenagers or young adults just starting their careers. This is Martha Ross and Nicole Bateman of the Brookings Institution's Metropolitan Policy Program, which conducted the analysis. Prime working years, or between about 25 to 54, they noted. Most of the 53 million Americans working in low-wage jobs are adults in their prime working years, or about 25 to 54, they noted. Their median hourly wage is $10.22 an hour. That's above the federal minimum wage of $7.25 an hour, but well below what's considered the living wage for many regions. Even though the economy is adding more jobs, there's increasing evidence that many of these new positions don't offer the kind